I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a REIT that owns logistics properties across the world. The global economy is such that goods need to constantly move across vast distances. In between all of that moving, logistics properties are critical, and that's where this REIT comes in. It owns and leases out thousands of industrial properties worldwide. In doing so, it's making a lot of money, and that allows the REIT to pay out a large, growing dividend. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Prologis Inc., which appear to be trading at a significant discount today. Prologis Inc., stock ticker PLD, is a global real estate investment trust that develops, acquires, and operates industrial and logistics facilities. Founded in 1983, Prologis is now a $104 billion by market cap real estate giant that employs over 2,000 people. The company's property portfolio consists of more than 5,500 properties comprising a total of 1.2 billion square feet. Its two largest markets by properties are the US, nearly 3,900 properties, and Europe, nearly 1,100 properties. Prologis leases its industrial and logistics buildings to approximately 6,700 different customers worldwide. Average occupancy for the most recent quarter was at 97.1%. There are two key components to the investment thesis here: criticality and cost. This company's facilities are critical to the global supply chain. The company estimates that $2.7 trillion in economic value of goods flow through its distribution centers each year, representing 2.8% of the world's GDP. Put simply, goods fail to move without the employment of these logistics facilities. Yet, despite the critical nature of these buildings, they form a low portion of the total supply chain costs. Per the 2022 CBRE Supply Chain Advisory, when looking at the distribution of supply chain costs, fixed costs, including rent, make up 3% to 6% of the total versus 45% to 70% from transportation. When something is both critical and low in cost, it's highly likely to stay in place and command higher prices over time. In addition, as the global supply chain grows and spreads out, this naturally benefits the likes of Prologis. And with the multi-decade trend of rising e-commerce still playing out, warehouses will remain a very important cog in the machine. This REIT is positioned very well for continued revenue, profit, and dividend growth for years to come. Already, Prologis has increased its dividend for 10 consecutive years. The 10-year dividend growth rate is 10.9%. Better yet, there's been an acceleration in dividend growth over the last several years. The 5-year dividend growth rate is 12.4%, and the 3-year dividend growth rate is 14.2%. That's a lot of dividend growth for a REIT, and just goes to show how great and unique Prologis is and has been. Most REITs that I know of are primarily income plays, and they're growing dividends at more meager rates that are in the low single-digit area. The stock also offers a market-beating 3.1% yield, which is lower than what your typical REIT features, but there's no major income sacrifice being made here. That yield, by the way, is 70 basis points higher than its own 5-year average. With a payout ratio of 62.3% based on midpoint guidance for this year's core funds from operations per share, Prologis has a well-covered dividend positioned for more growth ahead. In my view, prospective Prologis investors are looking at a very compelling mix of yield and growth here. Looking at business growth, Prologis moved its revenue from $1.8 billion in fiscal year 2013 to $6 billion in fiscal year 2022. That's a compound annual growth rate of 14.3%. 8%. While that's very strong top-line growth, it is somewhat misleading. When it comes to REITs, it's imperative to look at profit growth on a per-share basis. That's because REITs use debt and equity to fund growth, as they're legally required to distribute at least 90% of their taxable earnings to shareholders. This circles back around to the point I made earlier on REITs being income plays, and the limitations around internal funding for growth means tapping equity by issuing shares, which results in dilution. That tends to create distortion between absolute revenue growth and profit growth relative to shares outstanding. Also, when assessing profit for a REIT, we want to use funds from operations instead of normal earnings. Funds from operations, or adjusted funds from operations, is a measure of cash generated by a REIT, which adds depreciation and amortization expenses back to earnings. Prologis grew its core funds from operations per share from $1.65 to $5.16 over this 10-year period, which is a compound annual growth rate of 13.5%. That's admirable. I often see major disconnects between top-line growth and bottom-line growth when it comes to REITs, but Prologis put together similar growth on both ends. Really impressive stuff out of Prologis. Looking forward, CFRA currently has no 3-year compound annual growth rate projection for the REIT's funds from operations per share. That's unfortunate, as I do like to compare the proven past up against a future forecast in order to roughly gauge what the growth trajectory might look like. That said, we can still piece a bit of things together here. Prologis recently released guidance for fiscal year 2023, calling for core funds from operations per share to be between $5.58 and $5.60. At a $5.59 per share midpoint, that would represent 8.3% year-over-year growth compared to fiscal year 2022. I think it's remarkable that Prologis is putting up high single-digit growth during a very challenging environment for commercial real estate. It says a lot about the resiliency and durability of the enterprise, as well as the relentless demand for these industrial properties. I'm not sure that it would be prudent to expect Prologis to continue putting up double-digit funds from operations per share growth, if for no other reason than the fact that it's a much bigger REIT today than it was a decade ago. Prologis is starting the next decade with a much larger base. But what investors may lose out in terms of growth, they probably get back in terms of safety. I say that because this is an industrial property empire, and it's hard to imagine anything taking it down at this point. I like growth as much as the next investor, but there's something to be said about the idea of 5,500 properties making money while you sleep well. Overall, I don't see why Prologis can't put out high single-digit funds from operations per share growth from here, which would offer room for similar dividend growth. When starting off with a 3% plus yield, that's not bad at all. Moving over to the balance sheet, Prologis has a rock-solid financial position. The REIT has just under $24 billion in long-term debt as of the end of last fiscal year, which is relatively modest for its $104 billion market cap. A common measure for a REIT's financial position is the debt-to-EBITDA ratio, which is 4.2 for Prologis. I usually see REITs range from 3 to 7 on this ratio, so Prologis is definitely on the lower end of that, and I like that. As of Q3 fiscal year 2023, the company's weighted average interest rate on its share of total debt was 2.9%, with a weighted average term of 9.5 years. It's worth noting that Prologis has no significant debt maturities until 2026. In addition, the REIT has excellent credit ratings that are well into investment-grade territory, A3 Moody's and A S&P. Overall, Prologis is one of the highest quality REITs out there. The fundamentals here are second to none. And with economies of scale, switching costs, and entrenched infrastructure, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. A REIT's capital structure relies on external funding for growth, which exposes the company to volatile capital markets through equity issuances and interest rates through debt issuances. Adding to the rate conversation, higher rates can hurt this particular business model twice over. Debt becomes more expensive to take on and service, and equity can become more expensive because income-sensitive investors have alternatives, which puts downward pressure on the stock price. Prologis has exposure to the global economy, and any broad economic slowdown would naturally reduce demand for logistics via less movement of goods. The type of real estate that Prologis specializes in, which is logistics/warehouses, is simplistic, and it's not difficult for competitors to come in and build out warehouses on acquired land. Being international, Prologis has exposure to currency exchange rates and geopolitics. Any major changes in commerce, especially e-commerce, would impact Prologis. These risks are mostly fairly standard for a REIT, yet this REIT is anything but standard. And with the stock down more than 30% from all-time highs, the valuation is now a long way from standard. Stock is trading hands for a price to funds from operations ratio of 20.2. That's based on midpoint guidance for this year's core funds from operations per share. Being somewhat analogous to a PE ratio on a normal stock, that gives you a rough idea of where Prologis is at right now. Another way to look at it is the cash flow multiple. The price to cash flow ratio of 19.3 is well off of its own 5-year average of 27.7. This stock has typically commanded a heavy premium, but that premium is now pretty much gone. Also, the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. That dividend growth rate looks low or high depending on how you're approaching it. On one hand, it is quite high for a REIT, and I very rarely allow for a higher rate of growth when dealing with a REIT. After all, a lot of REITs are heavily indebted and grow slowly. They tend to be income plays. However, Prologis has shown a rare amount of growth in REITdom, and the balance sheet isn't as leveraged as what many other REITs are dealing with. The dividend growth rate I'm factoring in is much lower than the company's demonstrated dividend growth over the last 3, 5, and 10 years. Also, guidance for this year is calling for high single-digit year-over-year core funds from operations per share growth. I don't see why Prologis can't put up a high single-digit dividend growth from here. The dividend discount model analysis gives me a fair value of $124.12. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates PLD as a 4-star stock with a fair value estimate of $124. CFRE rates PLD as a 5-star strong buy with a 12-month target price of $131. Very tight consensus this time around, and I came out within pennies of where Morningstar is. Averaging the three numbers out gives us a final valuation of $126.37, which would indicate the stock is possibly 11% undervalued. Here's the bottom line, guys. Prologis Inc. is one of the highest quality REITs out there. It's benefiting from an expanding global supply chain and the rising trend of e-commerce. Its property portfolio has unrivaled size, scale, and geographic diversification. With a market-beating yield, double-digit dividend growth, a moderate payout ratio, 10 consecutive years of dividend growth, and the potential that shares are 11% undervalued, long-term dividend growth investors looking to increase their exposure to commercial real estate must have Prologis on their radar. And now for a special news announcement. Broadcom Inc., stock ticker AVGO, just closed on its $69 billion acquisition of VMware Inc. Broadcom has been a world-class acquirer and consolidator, and I have no doubt that this will continue with VMware now on board. We've highlighted Broadcom numerous times before on this channel, and I've even called it a dream stock. The stock is up 70% this year, which is just an amazing performance. If you don't yet have this high-quality tech firm in your portfolio, look for any good-sized pullback as a chance to change that. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.